Hello, everybody, and welcome to our monthly webinar for Elevate Wealth Advisory. I'm Betsy Kenyon, the marketing coordinator here at Elevate. Today is a special day for me with these webinars because it marks our 5-year anniversary of this webinar series. Before the pandemic, we used to hold in-person seminars for our clients to help them get information to live their best life in retirement and beyond. And we were seeking a way to still continue to do that. So we started this informational webinar series and it took off. And every month we tackle a different topic. Lifelong learning is a key core value of Elevate, and not just for our team to continue to learn, but for our clients to make sure they always have the tools and resources they need to live their best life. So today I'm very excited to have with us our president and CEO, Deanne Rosso, as well as Stu Bennett, who is the Senior Vice President and Co-Director of Focus Risk Solutions. So Deanne, I'll let you take it away.
Fantastic. Thank you, Betsy. And I don't even think I realized that this is our 5-year anniversary of doing webinars. Time just seems to really have flown. This is so exciting. And I love that every month we're able to dive into a topic that we feel is something of interest to our clients and something that's important to you when it comes to your financial planning. So hooray for a 5-year anniversary. That's exciting. As Betsy mentioned, I'm Deanne Rosso, President and CEO of Elevate. And at Elevate Wealth Advisory, what we do is, like Betsy mentioned, our mission is to provide our clients with the tools and resources to help you live your best life. And that means a lot of tools and resources. And sometimes that means tools and resources that are outside the scope of what we provide inside our office every day. So we are fee-only fiduciary advisors. And what that means to us is helping you focus on the things you can control, because we know there are tons and tons of things outside the scope of our control every day. And I know that today Stu is going to focus on a lot of those things that are outside of our control. But we drill our planning down to 4 key areas: cost, risk, taxes, behavior. And so when it comes to cost, we want to pay attention to every cost that's associated with when it comes to your investment and your financial planning. Risk, I'll talk about in a minute. Taxes, as you all know, we do a lot of emphasis on tax planning in our office and for our clients. And behavior, meaning choices. And we want to make sure the most important part of a financial plan is making sure that you stay on track with it and that your choices align with that plan. And to back up to risk, today is all about advanced planning, and it's all about the risk part of advanced planning. As the old adage goes, failing to plan is planning to fail. And so we want to make sure that your risks are covered when it comes to your home, your auto, your life, and things like that. And so this is one of those areas where we provide a lot of consulting for our clients, but as fee-only advisors, we don't sell product. We offer advice. And what that means is that we partner with companies that are going to provide that same level of service and put the client first, like we are, and that are looking for solutions for our clients' needs. And that's where Focus Risk Solutions come in. So welcome, Stu. We're very glad to have you with us today. As Betsy mentioned, Stu Bennett is the Senior Vice President and Co-Director of Focus Risk Solutions. They are a insurance partner of ours. A little background on Stu. You can go, I think Betsy's going to post a link to his LinkedIn in our chat box if you want to look into his background more. But he was an independent broker for over 20 years, and he's in the Los Angeles area. So you can imagine that he's seen a lot of risk management issues, particularly in that area of the country. But what's really attractive to us about Focus Risk Solutions is their client first, non-sales approach, and that they're here to educate the client and help us solve the client's problems. So welcome, Stu. And just to get to know Stu, I'm going to pose a question before he starts in on his comments, which is, Stu, what are you reading, watching, or listening to lately that you're interested in?
Well, thank you for that introduction, very kind introduction. I should let you know that, yeah, it's been a very challenging year here in Los Angeles. Just so you know, I was 3 blocks south of the evacuation zone for the Palisades fire. And it was a scary event. Of course, I've dealt with these types of catastrophes from a financial position for many years and objectively knew how the costs and effects were of these types of events. But actually having lived through this recent this fire and having many friends have lost homes and, trying to relocate and understand the pressures of that kind of thing, it's been a learning experience all over again. And so thank you again for the time to talk with your folks. You mentioned a book, and I was thinking I've been struggling to read A Brief History of Time by Stephen Hawking.
Wow.
I think I've reached my maximum in terms of intellectual challenge here in reading this book. It's of course not a new book, but I've sat down with it a few times, and I'm trying to get my arms around time. So that's what's going on in my life. I'm a single
Deep.
parent. I have
That's
a
deep,
22
Stu.
year old 22-year-old daughter, Isabella. She's at school. And I've been in the LA area for 30 plus years, having grown up here in Southern California. So, um, but of course, I'm doing business all over the country. So happy to join you guys today.
Well, thank you, Stu. And I think that's a deep read. That's an intellectual stretch. So,
Yeah,
if that says anything to the audience about the kind of effort that Stu puts into his business every day, and it really should. So,
I'm
take it
being
away.
challenged. Stephen Hawking is challenging. So, okay.
All right. Well,
So
I'll go ahead and share my screen and we can start the presentation whenever you're ready.
Okay, so I think before we jump into the slides, I'd just like to open up the conversation a little bit about focused risk solutions. So I think, Deanne, you did a great intro, but I would like to spend a little bit more time with who we are and how we get the business done for our focused financial partners and their clients. Focus Risk Solutions was formed about 3 years ago. I have a partner in New York, Eric Stein, who focuses primarily on life insurance and disability. I cover property and casualty for our wealth advisors. I also do some trust and estate planning for our business management group here in Los Angeles. It's a collaboration. Focus Risk is a collaboration of insurance professionals dedicated to serve clients in a fiduciary capacity. It's set up this way because we believe in the consultation process, and we believe that our role here is to provide a value add to the advisors and their clients, and provide enough education so that clients are informed and can make decisions about their quote wealth preservation, which really is what insurance is all about. So with that, I'll open up the floor to anybody with any specific questions that they might have about insurance before we engage with the slides here.
Perfect. So we do have a chat box and a Q&A box. So if anyone does have any questions,
Okay.
you pop that in there.
All right. So let's begin with the presentation. Let's go on to the next slide. Okay, so weather, yes, everybody knows we have some climate change. I'll stay out of the politics of climate change, but we all know that that storms seem to be becoming more severe. So let's just move on with that. We'll go to the next slide. This slide illustrates some of the in a big overview, some of the costs associated with different weather events: flooding, tornado, hurricanes, windstorms, and wildfires, which we all are fairly aware of. So I think we'll move on. This kind of gives you a better understanding of where the storms or what type of disasters are occurring across the country with a little bit more of a visual aid. I think generally we know that hurricanes in Florida and the Gulf states are primarily the biggest cause for losses there. And in the West, of course, it's wildfires and the occasional earthquake. But generally speaking, throughout the Midwest, we are dealing with tornadoes and wind and hail and flood, I think, are the primary causes of large losses in the middle of the country. We'll go on to the next slide. Flood continues to be probably the leading cause for loss across the country. It just doesn't seem to, aside from the big events like we had in Nashville last year, horrific event in North Carolina. It's these things get biased. Locally, there might be lots of media attention on these things, but generally nationally, unless it's a significant event like Asheville last year, it doesn't register. But it is a huge area of loss, and most folks are not covered. So I think we'll move on from here.
That's fascinating to me, those two, the amount of people who are not covered for flood. And just to interject or ask a quick question,
Sure.
is that because they are not proactively seeking flood insurance, or is that because it's not necessarily offered to them?
Well, I think it's a combination. I mean, I hate to be, it's a sort of a vague answer, but the reality is that most folks are perhaps a little bit uninformed about what it is that their homeowner's insurance will cover. And the fact is that, any HO policy is very limited in terms of any type of flood coverage whatsoever. Even in those areas where folks are a little bit more tuned in to flood because they may be in an actual flood zone or their mapping is putting them at risk. And mapping, I mean that by their actual location, their physical address, they might be at an elevation that is at risk of flood. Even when they have that awareness, generally clients are not aware of what their homeowner's insurance will cover. And even if they have flood insurance, either privately or through NFIP, they don't understand the coverage levels. For instance, just to give you a quick example, most folks don't, even if they have NFIP, any contents of their garage, their cars, equipment, things of that nature, and any other structure, that's not covered unless you have a private flood insurance policy. So there are folks who might be insured in those areas, Deanne, but they're generally underinsured for a specific event. Does that help?
That does help. Thank you.
Okay. All right, let's move on to the next slide. Okay, this is where I think we kind of get into sort of the nitty gritty on, the impact of cost, premiums, claims, et cetera. So let's move past this slide and I'll show you a couple of graphic examples of what's driving cost and premium and perhaps how we can sort of mitigate some of the costs going forward. This slide sort of represents, the appreciation and value of most homes across the country. The reality is that, just about 8.5% of homes now are considered luxury homes. What does that mean from the insurance standpoint? Well, it means that the replacement costs associated with taking care of a damaged home, whether it's a fire, flood, whatever the cause is, the cost of replacing the damage is going up each year. And especially in the last few years since the pandemic, it's created a lot of pressure with respect to construction costs and materials, electronic items, components, et cetera, that might be found, whether it's a home or an auto, the parts associated with making a home complete or an auto complete have increased dramatically, and or scarcity is creating problems with actually making a client whole, meaning a damaged automobile. Today, you take your Volkswagen Tiguan into the shop, you have to it's going to be in the shop for a month if it requires a bumper replacement with the sensors. Because first of all, in the supply chain, they've got to wait before they can get these supplies through to do the actual repair. And then they hope that they have a technician available to actually fix a car. So in a way, it's all of these little components that are involved in the claims process, appliances at home, heating and air conditioning, electronic switches, circuitry, etc. All of these things have become more difficult and more costly to acquire. So that's driving up the cost of the and the value of these particular assets. I think we should hit the next slide. Most folks aren't thinking about labor and when they're talking about their claims, but specifically to the auto industry, this has become a real problem. Getting enough qualified technicians in at dealerships to help support their service programs for automobile damage or claims and or just servicing and maintenance from a dealership perspective has been very challenging. There's not enough quote technicians ready to bring online to deal with the number of quote claims and servicing that these vehicles would have in their natural life. So the cost of that is increasing dramatically in the last few years. Next slide, please. Here's something that most folks don't think about in the event of a claim, and or when they're thinking about self-insuring. This is also a factor. The time that it takes to actually get the process rolling, the with the delays in materials and costs also come. There are permitting issues, especially in states that are where a home is located near a shoreline or a beach, or the permitting process has delayed the time in which a home can be repaired or replaced. That is a direct cost to the insured because, you have to live somewhere. Where are you going to stay? So that factor has driven up, again, more pressure on premiums so that you have a place to stay during the process of rebuilding. Next slide. Well, this is an area that's close to home for me, because it's not only affecting what's happening here locally within West Los Angeles, but this is going to impact. It's going to have a ripple effect across the country. In Palisades area, there are thousands of homes that are going to need to be rebuilt. Now, we don't know exactly what that's going to look like, but because of the demand that is going to be placed on construction supplies, particularly timber, that is going to drive up the cost of materials across the country. And I don't think that we haven't seen that yet, but it's going to happen because of the losses here in both Palisades and in at the other fire location here in Los Angeles. It's in Altadena. These fire zones destroyed so many homes that it's definitely going to be a blip on the radar with respect to national costs across the country. Next slide. This slide sort of demonstrates some of the component costs with respect to the new cars that are available to us, that most of us are driving now. They are super great, super convenient, and everybody loves the technology, generally speaking. And yet these components and systems are becoming, more and more complex, and they require a great deal of expertise in order to repair. So again, more pressure on premium pricing for our auto insurance policies. Next slide. I think this sort of describes what I've been talking about in terms of costs associated with replacement. I don't want to spend too much more time on that. Let's move forward. Again, some labor statistics with respect to cost and pressure on labor rates for automobile insurance. Next slide. One area that we haven't touched on yet is the type of claims that we are seeing. It seems like the severity of injuries are increasing. Um, and it seems sort of counterintuitive. You know, we have all of these safety systems built into our cars, right? Our sensors, our blind spot monitors, our our lead time when we're on cruise control, all of these things you would seem to think, well, that makes our cars safer, right? Well, the reality is that a lot of people are relying on those systems alone, and some of the quote old-fashioned driving techniques and training that we used to have haven't been sort of transferred as well to a younger generation. And that means that these folks are typically driving a little faster, a little bit more distracted now, especially with phones in the car. And so that's creating more severity with some of the injuries and claims. Now, there's another component to that, not just the actual accident, but there's a litigation factor here that comes into play. I think we're all inundated with accident attorney ads, whether it's on television or billboards, or whatever it is. They're all over the place. That's definitely a factor in the cost of claims. And I think we can spend some more time on that a little bit later on. Let's move on to the next slide, please. Social inflation. This is what I'm touching on, especially in states, California and Florida in particular. We have litigation pressure that has created serious issues. Some carriers have put out some literature on what it's actually costing us for some of these states that have had perhaps more liberal guidelines with respect to claims and litigation. Florida had for many years a contract clause in their insurance policies called assigned benefit. And basically what that meant was that as an insured, you could assign the responsibility and risk to third parties to actually make you whole. For instance, in Florida, many folks who had damaged roofs would bring in an insurance contractor and sign over their assignment of benefits to a contractor. Contractor would go out, replace a roof, and perhaps pad those claims costs, and then submit them to an insurance company. Of course, the insurance company would look at these and say, that doesn't look quite right. We're not going to pay that particular claim. Well, then enter the insurance litigators. So this sort of process built up a lot. There's a backlog of lawsuits in the state of Florida today that I estimate probably another 2 to 3 years before we get through it. And some of the regulations that were put in place last year will sort of take effect. And so that backlog of lawsuits will have to clear out before we see any improvement in the overall premium pressures there that are associated with social inflation. But it is a major factor. I think most carriers are saying it adds about another 30% to the claims costs overall. Next slide. Liability. Again, we're touching on an issue that involves litigation. And I think that for our clients that are listening today and advisors, my suggestion to you is that especially if you have adult children on your automobile plans, is to take a very close look at your additional liability, because in most cases, the underlying auto insurance policy will not have enough liability coverage in the event of a claim where you are, sued. They just are not built to take on that level of responsibility. So it's very important to have an automobile policy that has a liability or umbrella policy that's dovetailed, so there's no gap in coverage, and should be in excess of $1 million plus for most clients, especially, again, if you have teenage drivers. So let's move on. Okay, let's go ahead and move to the next slide. So with all of this activity creating problems and carriers pulling out of states, what's happening within the states that are impacted by these catastrophes? Well, as carriers are pulling out, other carriers are sort of being brought in because of the lack of availability. We refer to these carriers as excess and surplus lines. These carriers are fine carriers, and we utilize them in many ways for our clients with great efficiency. But generally speaking, these policies are going to be more expensive, and in some cases, the benefits that are built into these policies may not be as effective as a admitted carrier, meaning those carriers that have exited the state. Um, these carriers are also the excess and surplus lines carriers are also they're not required to and they don't have the protections that an admitted carrier would have with respect to their own financial solvency. So there is an element of risk in moving out to an E&S carrier. I wouldn't say it's a reason not to utilize them because many of them you're familiar with them. Lloyd's is an E&S carrier for many different in many different states with many different lines of coverage, and I wouldn't hesitate to recommend their using them. But there is an element of risk there that needs to be recognized, and that's the difference between a excess and surplus lines carrier and a admitted carrier. Let's move on. This map sort of dictates where these E&S carriers are being utilized, and as you might expect, it's the impact states or states where we're having severe losses, and admitted carriers are moving out of the state for the time being. Next slide. So this sort of sums up some questions in terms of where we are today, and what can we do? What should we consider doing as insurers and as consumers of insurance? How can we manage our plan? There are a number of details here that we can get into, but I think that there is a reason to pause here and see if there's any questions that might be brought up, any of these points.
Yeah, we do have a question. How often should we be reviewing our home and auto coverage?
Okay. My thinking is that this is something that should be done annually. And the reason is that the P&C market, or when we're talking about home insurance and automobile insurance, liability coverage, et cetera, this is a fluid market, and there are carriers that are moving in and out of specific markets down to the zip code, down to a street address. They may be pulling out, and some people might be pulling, looking at that area and saying, yeah, you know what, a carrier might be willing to take on more risk in one area, and another carrier that looks and smells just like them is pulling out. So it's important to kind of do this on an annual basis just to see where you're at, even if it's just a quick price check, to see if there's a more compelling reason to make a move. In many cases, the client or insured may stay, and we will provide that, information right up front saying, look, the market, depending on these conditions, you're in the best position where you should be. And so a market check doesn't mean move. A market check just means where are we today and what does the market have to offer us? So annually.
Interesting. Deanne, has this sparked any questions from you?
Maybe more of a comment, not just from like Stu was saying, not even just from a price perspective, right? I think when we think about having an insurance review, sometimes we're thinking about, yeah, we want to make sure that we're covered, but also from a premium standpoint, are we paying too much? And I think it's both. It is, maybe are we not paying enough because we're not covered? Our coverage level is not
Yeah.
enough. And, something that kind of sparked with me while Stu was talking was, as an investment advisor, when you're looking at an investment portfolio, it's kind of easy to see what level of risk you're taking by looking at your holdings, right? How much in equity, how much market risk exposure are we taking? That is very different in insurance. It's very hard to know how much risk are you taking on by being underinsured. And so, I would agree with Stu that an annual review of your coverage, and given all of the points that he's made already about how, we're seeing more and more disasters, or, I was shocked at the slide about under coverage on flood insurance, and just how much risk are you exposing yourself to by being underinsured?
Yeah, I think it's just a sort of a prudent, approach to, well, these are annual, you get a premium notice once a year, indicating, hey, you're coming up from renewal. It's time to take a look at this. Uh, it makes sense to look at this. There are also life events, Deanne, involved here. As our children age, or maybe we acquire another asset, or there's something that happens, life happens, and it may involve, an insurance component. My suggestion is that when they happen, it's better to be prepared on an annual basis, but we understand that events will occur, and we expect to react to those events, and perhaps provide a greater insight to how to proceed, even if it's just, hey, next year you should do this. We can offer those sorts of commentary on a portfolio review. So, and we discover lots of things along the way, under insurance, or there's a gap in coverage between an underlying automobile and policy and their umbrella. The clients don't realize that they're exposed by about 300,000 or more in the event of a loss. And it's just because that nobody's taken the time to kind of actually go through this with them in a thorough way. So, next slide. Okay, here are some things that we can do to help, I guess, mitigate some of the risk and exposure that we have. We talk about construction costs, replacement costs, and values, et cetera. Really important to pay attention to these particular notes, especially here in Florida, or in Florida. I was just there recently in Fort Lauderdale, and it's really, look, you have to know where your home is with respect to when it was built, what codes have been met, etc. And it's important to make sure that your insurance plan is structured around that, because you'll find that this is where gaps in coverage occur. And it requires, for those of us who own homes, it requires a certain maintenance, and planning place. I think that most folks don't realize that one of the best things they can do for their insurance plan is actually have an auto water shut off. It doesn't, it's just a small little note, a side note, but the reality is that most claims occur not because of events or disasters, but occur because of a burst pipe, or a fitting that has created a water leak, whether it's an air conditioner in Florida, or a water heater here in Malibu. Um, it's incredible how much damage these little things can create over time, because the replacement costs have gone up so much. It's well worth putting in $1,000 water shutoff valve in on your home, and you will end up saving on your insurance. And the insurance carriers will look at that as, hey, this is a homeowner that's thinking about risk, and they're more willing to give you a look, so to speak. So let's move on. Okay. Some of the things that we can think about is, how do we look at claims, small, I don't want to say trivial claims, but let's look at small claims. Insurance policies are really meant for disasters. The reality is that if you're you should probably not be making a claim in today's market under 5,000. You know, I think the mistake is that, oh, it's insurance, we should just use it. Well, hold on. In a hard market like we are in, if you've had a couple of claims right now, carriers are looking at that. You know, you're coming up for renewal and you want to do an investigate the market. If they see a couple of claims, small claims on your insurance history, they're looking at that and they're saying, no, thanks. We don't want, you're making claims based upon things that are less than the actual deductible. It's crazy. So I would suggest taking a look at deductibles, increasing them to, 5,000, something like that. That may end up helping you save some premium dollars down the line. And there's a few more bullet points that we can go through on there. But it's simple things. Alarms, fire alarms, a vault or a safe. If you've got valuables at home. But some of these things are sort of common sense in terms of what you can do to help mitigate risk.
Hey, Stu,
Next slide.
before we move on, Stu, would you mind addressing maybe that last bullet point, which is understanding the pitfalls of self-insurance?
Yeah, many folks are going in this direction. And I think that what they don't understand is time. I think the biggest factor is time, because they may have a visual on what it actually may cost to actually rebuild their home or, to make themselves whole. But they don't factor in the actual time it's going to take to actually get through the process. And that's where they make the mistake in terms of the math that it takes to actually take on this, self-insuring. And specifically, I'm talking about, hey, where do you live when your home's under construction? Did you factor in the extra time for zoning, permits, et cetera? Those costs can be significant. And so while there may be, some of our clients have come back to me, and those people who have said, no, Stu, I've got that under control. Those folks have typically been in real estate development. They maybe have a handle on how to acquire both labor and materials at a lower cost. But generally speaking, for the rest of us, that doesn't work out that way. And we don't have access to that type of, resources. So it's really about, I think it's time. And I think that that's the biggest factor in self-insuring that's hard to pin down. So hope that helps answer the question.
That does. Thank you.
Next slide. Okay. This is this is a case study that came up fairly recently that I think really helps define what we can do at the mass affluent level. And we all sort of have our numbers in our heads about what does that mean? What is mass affluent? But generally it's somewhere between 2 to 4 million in terms of net worth, and it usually means having a home, an auto, a liability coverage, perhaps a second home or vacation rental or something along those lines. And what this slide represents is the process that we took in taking a client that met those parameters, and we walked through the process of determining what was important to the client and really creating a more efficient plan. This particular client came in with 2 different brokers in 2 different states because their vacation home was located outside of their home residence state. And they had actually outgrown Nationwide, which is a fine carrier. I've written many cases through Nationwide. But in their particular case, Nationwide wasn't the right fit. And it was all about locations for them. Nationwide was hesitant and had increased their pricing in certain states. And we found that just by doing a thorough review and having an understanding of the market, that really these folks would be better served by moving up market in terms of carrier, and actually having contracts that were, I would say, more liberal in terms of benefits. And because of this particular carrier was looking at this market in a broader way, they were actually able to offer better pricing to this particular client, which is, it doesn't always work this way, but it did because we did the analysis. We took a really close look at what they had and where they were located. And, they had some good things going on for them. They didn't have any accidents or recent claims. They just had ignored their plan for a few years, and over time, that kind of caught up to them. So, in a way, as you can see in the lower right-hand corner, we were able to actually save them about 6,000 in premium. The total premium for this family was around $20,000 per year in annual premium. So it wasn't a small case, but the reality is that we found a better deal for them, so to speak, with a quote premium carrier versus nationwide, and it was an interesting outcome. But that's all done by just really thorough analysis, and there's no magic here. It's digging into the market and understanding who is the best match for the client. Um, Remember, we're agnostic in terms of who we select to solve a problem. We are looking for the best solution. We don't worry about a name or, who am I doing business with on the back end. This is all about bringing the right solution to the client. Next slide. Okay, so these are the pretty faces of Focus Risk Solutions. There will be others by the end of this year, I'm happy to say. Um, Eric Stein, again, I mentioned him earlier. He's our life insurance and DI specialist, also long-term care and annuities. He's seated in New York. I'm in Los Angeles, so we are bookends for Focus Risk Solutions. And we share the responsibility of managing and our brokerage partners who we execute our work through. And together we've been able to, create a really unique experience for our clients. I think that it's been very well received at the Focus Financial Partner level across the partnership. Folks have been very happy with the results that we've been able to bring. And it's about partnering with good people who are like-minded. And I think that's where it kind of comes down to. So I hope you guys have found this helpful. I'd like to open up, the floor to questions if there are any. And if you'd like me to spend some more time on something, I'd be happy to do so.
Not a question, just a comment. I think a lot of people don't, when they're purchasing insurance, they might just go with their local insurance provider that they might know personally, that they met. And so maybe people don't realize that there are options out there that they've never heard of. So do you run into that a lot?
Yeah, and I'm glad you brought that up. Thank you. One of the advantages to working through our platform is that we partner with national brokerages, and because we can offer our broker partners a large volume of cases, we get a lot of attention with our national underwriters. Now, that might not necessarily be the case with a local broker because they're just not going to have the scale that we have through our partnership at National Brokerage. Also, I think probably the most common quote thank you that I get from clients is that it wasn't so much about the costs per se in terms of saving premium. It was about the way it was being managed. Clients would say multiple insurable assets in different places. It becomes a bit of a mess. And what they're looking for is a way to efficiently manage their program. So I think what the thank you is, thanks for coming up to us with this plan. Now I understand it. It's easy to read. The portfolio review was easily understood. I've got one national lead broker who manages a team underneath them, and they handle everything. And so that efficiency is probably the biggest value add that we can have. And it just, that peace of mind and the fact that it's, quote, easy rather than managing multiple relationships.
Fascinating. How
So,
about for you, Dan?
Yeah, so many key points taken away from Stu's comments today. Ironically, that it's ironic that you were reading the book, The Brief History of Time, and we've talked a lot about time. But one of the things that I've seen, in my experience with my clients who have had, issues, and I mean, talk about issues. We were just talking as a team this week about two of us had little minor pipe burst issues this weekend. Those things happen. Three of us out of a team of 12. So that's
We
pretty
had an
healthy.
overflow in our basement of our air conditioning got clogged as well. Just like
Yes. Those
yeah.
things happen and they happen, quickly and they happen without you realizing it. And sometimes you're away on vacation, but things that, I think maybe one key um a moment or a light bulb moment that I've had is, it's not about being overinsured and it's not about paying the highest or the lowest premiums. It's about making sure that you understand what risk you are assuming and looking at your insurance as a portfolio. I like how, Stu, you described it as a portfolio, because when we're advising clients, a lot of times what we're looking at is an investment portfolio, but part of your resources are your physical assets, your home, your auto, your jewelry, your collections, your things like that. And looking at those as a portfolio and having that plan for those assets, just like you have for your retirement assets per se, is really important. And it's something that's often overlooked, I think, or not reviewed as often as it needs to be.
Yeah, we used to talk about years ago, bundling is still a word that you hear used, especially on any, progressive, flow. The
Mhm.
commercials, it's all about bundling, well, the general understanding was that if you attempted to bundle something, the reason that you'd want to do that is that you could get a discount, right? We all get a discount if we put all our stuff in with one carrier. Great. But the reality is that in today's market, bundling is not about necessarily a discount. It's about actually finding a market, because insurance carriers are very reluctant to write mono lines, meaning a single line of coverage. And so my approach has always been look at a portfolio, take a look at the overall risk, personalities and lifestyle choices, et cetera, all mixed in with this, but then take it to a carrier as a portfolio. So in case there's an element of risk in that portfolio that maybe is less desirable, you will still get a market to look at that because they're looking at a number of different lines of risk, lines of coverage. And so that provides access to more markets. And so in today's, in the conditions that we're in today, that approach is it's necessary. It's no, you should be doing this because you cannot just look at, hey, I just need a new automobile policy. No, it doesn't work that way anymore.
Yeah,
So thanks for bringing that up.
sure. And, I think another thing that we hear a lot, whether it's, socially generated by social media or just conversations that we have, is like choosing a carrier based on their ratings or their claims payout ratings, and thinking about you guys and what it is that you do. I'm sure that's part of your carrier selection process, is looking at the ratings of these insurance companies and what is their claims payout rate in their process and things like that.
Yeah, it's important to look. This is all, it's about taking care of a client and their actual client, but there's a reputational issue here as well. We are an association of folks who are professionals that want to be able to count on individuals performing. Well, for our clients, we expect our carrier, and in the insurance world, we expect our insurance carriers to perform. And so no carriers coming into our program without an AM Best rating, A plus better. It's just not it won't happen. I wouldn't let that happen. I have brought carriers to clients in the past indicating this may be a regional or small carrier that's available to you in this particular market. And I might say, I would suggest you use them for a year or two, if there was no other option. But I am always very cautious about the size of carriers and what their market exposure is. So this is something that both myself and my brokerage partners are looking at continually, to say who's in the market, who is reliable, and because that all comes back to us if a client has a bad experience. So we don't want to get in that game.
Exactly.
Yeah.
Well, we really
Um,
appreciate your time today so much, Stu. You've been amazing, and we're looking forward to working with you over the next few years to just do periodic reviews with our clients. And Deanne, do you want to talk a little bit more about how that works for our clients?
Sure. In our client process, as I mentioned earlier, it's focused on what you can control. But generally, when clients come to us, a lot of times the number one question on their mind is, am I saving enough? Can I retire? Is my portfolio in the right place? That's what you think about when you think about a wealth advisory firm. But it's so much more than that for us. It is that investment consulting piece. It is that getting you on track to retire. It is also the advanced planning piece, and insurance is a huge part of that advanced planning. And so what are the things we're focused on with advanced planning? Well, those are the things that we think can really maybe compound your rate of success or get you to the finish line or stretch every dollar as far as possible. And by that, we mean things like tax mitigation strategies. We mean estate planning and making sure that the right person gets the right asset at the right time. We mean, if you're philanthropic, what's your charitable giving strategy that's going to make maximum impact with that gift? And then, of course, there's the risk management piece of it too, and that comes in a variety of flavors as well. The things as simple as beneficiary designations or account titling, liability protection from our overall theme with risk management is making sure that your assets are not unjustly taken from you. So what are your risks? And so that's what the client experience is like for us. It's looking at all of those things that are most important to you and how can we help you achieve those, and what solutions can we bring to the table that will help you live your best life and have the best chance of success in all those things that are most important to you. So I appreciate so much Stu and Focus Risk Solutions and partners that we have like Focus Risk, because we know that in-house, we are not experts at all things. It's our job to connect our clients with those resources. And we're so grateful to have partners like Focus Risk that will help us bring those solutions to our clients.
You're very welcome. Thanks for having me.
And if anyone has not had their question answered, please email marketing@elevate-wealth.com. We'll get you in touch with Stu or Deanne to get your questions answered. And then visit our website at elevate-wealth.com, and you can look at all our upcoming webinars. Next month, we'll be focused on retirement planning. So that will be with our wealth advisor, Clark Holt, who just celebrated 22 years with us yesterday. So we look forward to seeing you then, if not sooner. And thanks again, Stu, for all of your help with this.
You're welcome. Have a great day, guys.